Hi everyone, welcome to my channel, All Things Accounting. Today what I will be taking you through are some ratio analysis. In particularly, we're going to be dealing with solvency. I'll explain what that is and we'll go through some formulas and I'll deconstruct some of these formulas and explain to you and take you through step by step. So stay right there and we'll go through this together. So solvency, what does solvency mean? It refers to a company's ability to remain in business over the long term. Okay, so what we want obviously is that a company to remain healthy financially as long as possible so that we can generate income. Now, it concerns with the ability to financially be healthy over the period of both short-term and long-term for the amount of debt that is outstanding. So one ratio that is quite important and is widely used is what's called the debt to equity ratio. So this is calculated as total liabilities all over total shareholders' equity. Okay. Now, as you can see here, the total liability over total shareholders' equity, we're dealing with the right side of the accounting equation, or one side of the balance sheet in itself. Let's say, for example, that this ratio equals to 89 cents. So what does that mean? That particularly means that for every $1 of capital that the shareholders provide, creditors have provided 89 cents as well. So what's an acceptable rate? Then we can ask. Well, that ultimately depends on the company's policy, the history of the company, and the nature of the industry in which the company operates. Another useful solvency ratio is called times interest earned ratio. And what that means is it indicates a company's ability to meet its interest payments. So that's calculated as net income plus interest income. So interest expense, and plus income tax expense all over interest expense. So net income plus interest expense plus income tax expense. So this is also called earnings before interest and taxes. So short form would be EBIT. Okay. Now, the greater the interest coverage, the better it is as far as lenders are concerned. Interest expense and income taxes expense are added back to net income because interest is a deduction in arriving at the amount of income subject to taxes. The next one we will cover is debt service coverage. Now, this is a statement of cash flow measure of a company's ability to meet its interest and principal payments. It's calculated as cash flow from operations before interest, before interest and tax payments all over interest and or interest plus principal payments. Okay, so again, cash flow from operations before interest plus tax payments all over interest plus principal payments. Now, the problem with the times interest earned ratio that we examined before this one is that the denominator only concerns itself with interest. However, management must concern itself with the principal payments as well for loans that are going to be maturing in the near future, usually the next year. Also, the numerator in times interest earned is not a measure of cash available to repay the loan. Remember that non-cash adjustments such as depreciation affects the determination of net income. So these are just 3 quick ratio analysis and of some useful solvency ratios. I hope you found this tutorial to be useful. Please subscribe to my channel and hit that like button and click that bell notification icon so that you'll always be up to date on the new videos and tutorials that I'll be posting. Until next time, take care.